Yeah, hi, and welcome to the next episode of FINtastic Talks. So, guys, again, as I like to start with a gratitude. Thank you for always being there, and thank you for coming and attending these talks. And I hope these talks are adding to your wealth and helping you be on your journey for a second income. As I always mention, that the second income means that one day your income from your investment should match or be more than your income from your job or the business. And the day you are able to do that, you are able to build a truly a second version of yourself. And that you can only do if you start investing properly, professionally, with a good wealth management firm like Bajaj Capital. Obviously I need to market myself, and that we help you create that wealth. There are some very nice, exciting products available in this market for you to create wealth, and you need to put them in your portfolio. And for those of you who are new, I will say that please attend things like FINtastic Talks to build your bill. And we have a fantastic program also, which is run by International College of Financial Planning, which helps you build your basics. Because once you understand the how to manage money and what is right, what is wrong, what to do, then there's nobody who can misguide you, and you will achieve your goal. So this 10-15 day investment or some few thousand rupees investment into your wealth creation journey is very, very important, and that I highly recommend to all of you today. So today I have one of the most popular CEOs from the mutual fund industry, Ashish Somaiyaa from WhiteOak Capital, which is becoming supremely popular. They are, they would be one of the fastest growing asset management managers in the country. Their funds are performing very well. So without further ado, let me call Ashish to join us today. Yeah, Ashish, thank you for taking out time and being with us today.
Thank you, sir. Thank you for inviting me. It's always a pleasure.
No, it's always a pleasure to have you. So, Ashish, White Oak has been on a rocket ship. So why don't you tell us that what makes White Oak special, and why is it been getting such a nice love and affection despite being one of the youngest and the newest players in the market?
So, sir, thank you. I think in our industry, two things are completely non-negotiable. I think one is the trust of, partners like yourself and the trust of investors, most importantly. And the second, of course, is that, we are living in an era where the industry, at least the industry that we represent, which is related to fund management, mutual funds, portfolio management services, etc. The industry is extremely meritocratic and extremely democratic because of the digital world. So I think first is clearly the trust of investors. Second, of course, is the performance of our investment team, and then of course White Oak has got a fair amount of reception in the market. A lot to do with the track record of our founder, that is Prashant Khemka. So, he founded White Oak about 5.5 years back, somewhere in June 2017. And before that, for about 17 years, he was with Goldman Sachs Asset Management. He has continuously been managing India equity portfolios right from 2007 onwards. And for the moment, if somebody were to actually aggregate his entire stint of 15 years of India equity track record, he has, outperformed the benchmark by about 6 to 7% compounded year on year over 15 years. And then plus, of course, we have built around him. We have also built a very large equity research team. We are about 30 people covering more than 600 companies in India. Everything over 1,000 crore market cap falls into our universe, and we have a very large team covering this universe. So I think a combination of multiple factors. I think the credibility of the team, the track record, the believability, and of course, the support and trust.
So Ashish, tell us yours the journey of White Oaks as a mutual fund alone. So when
Yeah.
did you start? What is the number of schemes? What's the assets under management?
So actually, we are still actually, if you ask me, by virtue of say entry into the industry, we are the recent most entrant into the industry. This year, a couple of new players have entered. Our first fund came only in July 2022, so you can say barely now, 5 to 6 months. And we are about 2,000 crores of assets under management in equity. We are about 1 lakh investors, and more like out of 1 lakh, we are purely a retail fund house. Out of 1 lakh, almost 40,000 are SIPs. Very, very early days for us. But in terms of the funds that we have launched, our entire WhiteOak as a group, our founder Prashant and the 30-member team that I described, the entire ethos is all around centered around managing equity portfolios. So till now, we have created a flexi cap fund. We have created a mid cap fund. In fact, very unique because our mid cap fund takes money only by way of SIPs and STPs. We have created a tax saver fund, a large cap fund, and then on the annual, we're just creating a basic product range. So on the annual in January, we'll have a balanced advantage fund, and maybe sometime in February, a small cap fund. But even the small cap fund will only take money by way of SIPs and STPs. So early days, 4 products have been launched, 2 more to go, and we are at about just over 2,000 crores of equity assets.
And this is in how long?
So, of course, see, WhiteOak Group, I mentioned WhiteOak Group came about 5.5 years back. So that is about $6 billion. But only the mutual fund is last 5 months.
Okay, superb. So the 5 months track record is fantastic, Ashish. And your AIFs and your PMSs are very popular now. So what's
Yes.
the amount of assets in your AIF and PMS? Because that's one of the attractions to White Oaks for the retail investor is that earlier you were only available to the high net worth investors, and those
Yes.
high net worth now the investors who can't afford to commit 50 lakhs or 1 crore rupees also have an access to White Oak. So how much money are you having in your PMS and AIFs?
So the PMS is approximately just under 10,000 crores in size, and the AIFs are about 3,500 crores in size. But yes, I think the idea is that if we think we have the competency and the talent to manage money in equities, and given that we have a long track record, we would do everything in our power, everything in our capability to ensure that we are able to make our services and our talent available to retail investors. That is why so much effort has gone into creating the mutual fund.
Yeah. In fact, the guys who are viewers, this is one of the most interesting points with White Oaks is that this was only available to high net worth individuals. And people used to look at the performance of White Oak and come and say, look, I also want to be a part of this journey. And they could not participate in that journey because of the PMS and AIF requirements of having, minimum amount of capital. And that has been the one of the reasons why within 5 months they have reached 2,000 crores. And I know a lot of the people who are going to be watching this program are also either already invested or sitting on the fence and thinking, should I add White Oak to your portfolio? Now you have the opportunity, and we'll be deep diving more with Ashish into various schemes. So Ashish, although you are now coming on the second season, and you were with me in the first season also, and we have been able to cover your background. But what we would like the people to know the CEO as a person. So I know without wasting too much time, just tell people a little bit about yourself and what makes Ashish Ashish, and what has been your journey.
No, very kind of you to ask that. I am basically, by birth, I am a Gujarati, but born and brought up in Mumbai. So my family originally we belong to Saurashtra, more specifically Rajkot. I love going there, but I've never lived there. I was born and brought up in Mumbai. Uh, Early days, I've studied in Mumbai, uh, but as far as my engineering is concerned, I went to Pune. So by training, I am a chemical engineer. More specifically, I've studied polymer science, and I worked couple of years in a factory. After that, I decided to do postgrad in finance. Because right through my engineering days and when I was in the hostel, at that time, what the youngsters now watch as Scam 92 in OTT, but when that actually happened, I was in college. And while there are a lot of negative repercussions of such incidences, the only positive fallout I can think of is that those are the times when the stock market reaches from economic times straight into the times of India and the midday of the world. So that is how they capture our imagination that ऐसी भी दुनिया होती है. So I think right from my engineering days, I got hooked on to reading about the stock markets and following what happens in the markets. So after a couple of years of an engineering job, I did my postgrad in finance. And then, in 1999, I was a trainee. I was learning about the industry. I joined ICICI Prudential Mutual Fund. So first 12 to 13 years at ICICI Mutual Fund, then about 8 years I was CEO for Motilal Oswal, and last 2 years CEO at WhiteOak. So that is my journey. But I have always, the entire 23, 24 years, I've always been associated with the mutual fund industry. And I think I'm thankful for that.
Yeah, that's superb. So, Ashish, it's good to know that journey. And for those who want to know more about Ashish's journey, so you can go to the FINtastic Talks website and you'll find Ashish's profile and his journey there, and some key highlights from our last talk. And hopefully soon you will get highlights from this talk also. So, Ashish, also now coming to the topic, what is the view of White Oak's Capital on what is happening in the global economy? People are saying world is heading for a recession, yet India is going to dodge the recession. So, and India is going to be the different one. And we are now seeing some FII money coming back into India. Is that correct? Or these are just, is it a trend or is it, a short-term phenomenon? What would you like to say about these things?
So I would like to first give a slightly big picture about what is exciting, and at the same time then come to the near term or the more micro picture related to the here and now of your question. But I think as far as the big picture is concerned, anybody who is investing in India, they should just look at only one simple sentence and a little bit of arithmetic behind it. It's like this, that the world's GDP, the annual output of the world in a given year is approximately $95 trillion. Now, before, 2 3 years back, if you go before COVID, out of this 90 to 95 trillion, US economy was 22 to 23 trillion, and in a good year, the US economy would grow by say 3.5%. So the annual incremental output of the US economy on 20 to 23 trillion would be more like 3%, so say 700 billion. If you take China, it was 16, 17 trillion. If they grew 6, 7%, then they would grow 1 trillion. Now, the point is that the world's annual output of 93 to 95 trillion in a good year would grow 2 to 3%, say 3%. Now, what happens is that if the world's growth is 3% on over 90 trillion, that means the world is growing 2.5 to 2.7 trillion. And out of 2.5 to 2.7 trillion, till very recently, 60-70%, like the arithmetic I told you, was just US and China. And where was India till 3 years back? On 2.5 trillion GDP, we grew 3.7% in 1920, which means that our addition, our contribution to the world's growth was 100 billion out of 2.5 or 2.7 trillion. So, in one simple sentence, till 2 3 years back, India was contributing 3, 4, 5% to the world's growth. All our audience, for a moment, if we take a wild guess, what is India's contribution to world's growth this year? It's over 20%. So this year, the world will not grow 2.5 to 3 trillion. World will grow between 1.5 to 2 trillion. And India will end up adding anywhere in the range of 250 to 300 billion dollars to the world's growth. So from 100 billion contribution to 2.5 trillion growth, we have gone to nearly 300 billion contribution out of the 1.5 trillion growth. And people say that in the next 10 years, India will consistently contribute over 15 to 20% of the world's growth. Why do you need to know who is contributing the world's growth? Because investment always chases growth. If there is no growth, there is no investment. And if India is going to contribute 20% of the world's growth, it is going to be the biggest labor market, the biggest consumer market, and hence the biggest destination for investment in the world. So I think this is what, in simple terms, this is what should excite anybody who is an investor in India. And I think that things have changed for the better. Next 5 to 10 years is going to be a great time. Of course, coming back to here and now, what will happen tomorrow morning or what will happen next month? So the long-term vision is very, very clear. We are in for some great times. But right now, if we look around us, we seem to be doing relatively well. But the point about doing relatively well is like this: that if you have a beautiful house in a bad neighborhood, then you cannot run away from the disturbances. So while we are doing very, very well and we have got onto a right path, the problem is that it is US, all these things are causing some headwinds to us. So there will be volatility, there will be ups and downs, but if we can look through this period and understand that this is the right way to do it, then I think we will be able to manage this
We seem to have lost Ashish's voice. So till Ashish is able to make a comeback. So this was a very interesting point made by Ashish that India is going to contribute to 20% of the world's growth. This is something, this figure I will validate, and this figure is something even I didn't know. But it's a very interesting figure. And when you look at one country that is going to contribute 20% to the world's growth, and if they are able to maintain that and sustain that, then India is on a very, very right track. And guys, everybody needs to be investing in Indian equity. Now, the next question you guys will have is that how do you get into it? Now, here, let me tell you the biggest mistake what we make is that, this is again a huge fallacy of the market, is that we invest by ratings. We go to the some of the websites and we see this fund is rated 5 star. This fund is so I let me pick up that fund, or this fund has given delivered a 25% IRR in the last 2 years, 1 year, 3 years. Then this is the right fund for me. But this is again a very, very important point, guys. Don't invest on the past, because what market proves that whoever has done the best for the next last 1 year, 2 year, 3 years, the reason he's done the best is because the strategy he had has had worked. But strategies in the market keep changing, the market dynamics keep changing. So generally, typically a fund which is amongst the top can be the worst performer in the next 2 3 years. So and that's where most of the people have a bad experience. Okay, look, when I invested in this fund, it had delivered an 18% return in the last 3 years, but it's not delivered 18% to me. When I've invested, I've only got a 7%, 8%, 9% return, because that is why you were investing in the past. And a lot of people ask me this question that, how do we invest in the future? So Ashish, good to have you back. I hope you have been able to hear what I was talking
Yes,
about.
yes, yes, yes,
How do
absolutely.
people invest in the future? This is a very important point, and this is the one of the biggest banes of our industry, which causes this problem that, look, my returns are not as much as I saw, because we have trained people to look at past returns.
Hmm.
And what is happening, the people who have performed in the past, it's very difficult for one strategy to keep on working. Otherwise, everybody would be a billionaire. ठीक है? So strategies keep changing. Like there is a person who believes in value. So there are 3, 4, 5 years where value will drive. And there
Yeah,
are times where the whole index will go up. And we'll have the experts saying, oh, you should only invest in index funds. Look, index has done better. But that index has done better in 6 months or 1 year. It's not going to do better. But if you look at there were 2, 3 years, then only the couple of stocks, maybe 10, 12 stocks. So the
yeah,
extremely concentrated portfolios were doing the best. So these were called the growth stocks. So
yeah.
so these things keep on changing, and people invest in the past which gives them a bad experience. So how do you identify what's going to be the future, Ashish? Obviously, Bajaj Capital is one of the ways where we
Yes.
try to do that. But what are the other ways where people invest in the future rather than investing on basis on the past?
I think you made a very, very, the description you gave, sir, that itself was quite insightful, because it's a fact that, at different times, different strategies work well. And if you look at last 1 year, you might start thinking that this was the right way to do it. See, the reality is that, in order to make their, stock picking, to divide, to, come up with a particular framework, or to give a particular method to the madness of this whole stock picking related matter, The point is that different fund houses, different fund managers, they do narrow down their universe. See, it's like this: there are more than 7,000 listed companies. If you take out all the small ones, let us say I said that we cover everything more than 1,000 crores. Now, everything more than 1,000 crores is also 900 plus companies in India. Now, within that, you can always say that, Abhi, how can we cover 900 companies? So let us do one thing. Let us devise our own mathematical model that let us buy only companies which are more than 15% return on equity and more than 10% or 15% sales growth. Somebody will say, I will only buy companies which are low price to earnings. Somebody will say, I will only buy companies which are very, very high quality multinational companies. So different people, what they do is that they arrive at some or the other way of slicing and dicing the market universe. And in order to make life easier or to make it more predictable, they try to buy a certain set or a certain type or certain cohort of companies. Now that's why, like you rightly said, sometimes quality companies work well, sometimes low PE, low price to book, sometimes public sector enterprise, sometimes just few stocks of the index. That is where winners rotate. Now, the key point to keep in mind how to identify a fund house or a fund manager, key point to keep in mind is that the market is, say, BSE 500, 500 BSE stocks, that is 96% of the total market value. This BSE 500 is not growth or value. It is not MNC or domestic companies. It is not defensive companies or cyclical companies. BSE 500 is everything. It's the whole market. Now, if you want to identify a fund which is going to consistently beat the market, then the point is that their strategy should not be narrow. Their strategy should be broad based, and the strategy should have all types of sectors and all types of stocks. So basically, if you want to beat the market consistently, then how narrow your strategy is, it will be inversely proportional to consistency. If you ask me, a narrow portfolio can give very, very high performance, very, very high alpha, but it is most likely to be inconsistent. Whereas a broad based portfolio might sometimes give you slightly less alpha, but it will give you more consistency. So, not to get into complexity, the simple point is that if you have broad strategies which don't make the market into narrow cohorts, but which enable the fund manager to pick stocks from a wide spectrum, I think that is most likely to have slightly more consistent performance. Whereas narrow strategies, they can do very, very well for some time, but then they're again likely to rotate out of favor. So I think clearly, like you said, you need good advisors. But on the other hand, and it's not easy to just pick funds like that. But in my own way, I've tried to explain that, highest alpha but inconsistent. That is one way to look at it. Second is slightly less alpha but much more consistency. I think that will come from a broader strategy.
Yeah, I think beautifully explained, Ashish. That if you want consistency, then go for a broad fund. If you want, high growth, then you go for a concentrated fund. So typically, tell me one thing. Like, suppose somebody picks up a WhiteOak flexi cap fund. So now, is that a concentrated fund or is it a?
Yeah. No, so see clearly, we definitely eat our own cooking, and our funds. I mean, all our funds are broad based, not broad based just from perspective of number of stocks. The idea is not to just broad base from spray and pray or just broad base from a number of stocks perspective. When I say broad based, our benchmark is BSE 500. So obviously, our portfolio has to have some representation of BSE 500, but with much better stock picking. That's the idea. So, when I say broad based, our fund, we invest in all sectors. We don't say no to any sector. So, we invest in all sectors. We invest across large cap, mid cap, and small cap. Our fund is called Flexi Cap, but we are 40-45% small and mid cap and 50-60% large cap. We are not growth or value, we are blended style. We don't have a portfolio beta of 0.7 or 1.2. We keep the beta close to the market, which is more like 0.9. So that is what I mean. Balanced portfolio construction, all types of exposure, all sectors, all market caps. So it is got some overlaps, or it has got some, it has some shadow of the benchmark, but only with better stock picking. That's the key point.
Yeah, that's interesting because typically that has been the strength of White Oak. of having a very
Absolutely.
balanced portfolio. I remember our last talk where you said, look, we are not a large cap player, we are not a mid cap player, we are not a small cap player, we are not a growth player, and we are not a value player. So we like to be a sort of a blend of everything. And that's what makes WhiteOak unique. So it's good to note that you are actually following that strategy.
So
And
because yeah, sir, because the market, see, the market is everything. The market is everything. So if you want to beat the market consistently, then you can't say that I will do this but not do that. I think that's the key point.
so, Ashish, let me ask you, there's a question by Harish Rawat. He's asking, is there a way to make savings a daily habit? Now, guys, saving a daily habit is up to you. Okay? So, at the end of the day, simple put that, whatever is your income, you need to see, okay, what is the amount of money I need? So, first, it starts by making a budget. The reason we don't save is because we don't make a budget. Okay, so if we make a budget, like so then these are the amount of money I'm going to spend on A, B, my food, my electricity, my this thing. Then these are the essentials. Then comes the luxury. That what because this life is for living, and if you don't invest in luxury or you don't enjoy the life, then what's the use of having the money? So then you invest in that luxury. That okay, this is what I want to do. These are my the luxury habits, and then this is my saving, and then remaining amount that you want to allocate is that you allocate to your big time goals, that or your mother big time, not goals, because that will come from your savings. But what I meant was that if you want to take a foreign trip, or you want to take some big time luxury things which are going to be high cost, then you put some money aside for that. So it's, if you make a budget, then you can make a habit of saving. And then systematic investment plans are again the best way to do that, because these are the most flexible thing. All you have to do is go to like a MF online at Bajaj Capital, open your account, takes maybe 15 to 20 minutes, commit an amount, maybe anything as per 5,000, 10,000, 50,000, 1 lakh, depending on your capability. And even if 1 month you don't have the money, your SIP is going to continue. Okay, so it's like for most of us, due to some reason or other, couple of installments will get missed, and that's the strength of this product. Like an insurance plan will lapse even if you miss one installment, unless it's a ULIP. But in case of a mutual fund, it doesn't lapse. Okay, so even if you can't contribute for a couple of months, that's fine. So that'll be just, maybe if it's more than 3 months in a go, then that's a problem. But otherwise, there's no problem. So Harish, I'll say to make it a daily habit is start a SIP. That's the most important thing. And for those people who have a lump sum, and they don't want to risk, then systematic transfer plan, STPs, are a great way to start your saving habit. This is absolutely must. Ashish, would you like to add something on this?
Yeah, I think that, it is absolutely possible to make it a daily habit. I'll just add one more dimension to this, that when you say make a daily habit, in case if your question is meant to be literally, can you save every day? Then again, the answer is yes. Because, like Mr. Bajaj mentioned, there is an online platform with Bajaj Capital, and you can invest, theoretically, you can invest in a mutual fund literally every day, because the smallest ticket size in a mutual fund is as less as 500 rupees, or in some funds even 100 rupees. So theoretically, if you were to trying to say that, can you invest literally every day? Yes, you can invest literally every day, and you can invest every month, every fortnight. The minimum ticket sizes are quite low. So whether you invest 10,000 rupees in a month, or you invest 500 rupees every working day, the choice is yours.
Yeah. So, as Ashish has very clearly said that you can actually do it every day. Then, before we go on, guys, one thing I want to tell: anybody has any question, you can write it on the comments. We are able to see the comments across the platforms, and we'll try to take up your questions to as much as possible. So there's a very different question, Ashish. I don't know whether you like to take it up or not. Tejas is asking a question. The three digital asset management companies are under ED and IT scanner. So is this is the Indian market safe, or Indian market is so what would you like to say about that?
No, so when you say asset management companies, by the way, there is a asset management company is a legal term. Only a company which has a license from SEBI to manage mutual funds will is allowed to be called an asset management company. By the way, today if you go to Ministry of Corporate Affairs and apply for Ashish Somaiyaa and company and tell Ministry of Corporate Affairs that I want to call it Ashish Somaiyaa Asset Management Company, they will question that, are you a SEBI licensed mutual fund company? So first of all, I don't think that there are any digital asset management companies, because asset management company is a legal term given to a company which is managing mutual funds. So I don't think there are any SEBI licensed mutual fund asset management companies which are currently under any ED or any IT scrutiny. If I were to take a guess, I think you're referring to crypto companies which have been running exchanges where there is a perceived, I am not the right one to comment, but what I read in the newspapers, perceivedly there is some foreign exchange violations and they are being investigated by ED and income tax. But let me tell you, none of the SEBI licensed asset management companies are under any action of any enforcement directorate or any income tax right now. So the ones which you are referring to are certainly not asset management companies. If somebody calls themselves asset management company, you should be asking them for the license number or the registration number from SEBI. And as far as all SEBI regulated entities are concerned, whether it is Bajaj Capital as a advisor or a financial mutual fund distributor or a financial advisor or even a PMS manager or WhiteOak, all of us are SEBI licensed entities, and the money in all SEBI licensed entities is absolutely safe. There are no such challenges, right? If, for example, if you invest your money with a mutual fund, you are not giving your money to WhiteOak Capital Asset Management. You are giving your money to WhiteOak Capital Mutual Fund. What is this mutual fund? It is a trust. Where does the trust hold your money? It holds the money with a third party custodian, which in our case, the custodian is a Deutsche Bank, and Deutsche Bank again is licensed to be a custodian by SEBI. So there is a very, very intricate framework of governance and very, very intricate framework of regulations for all SEBI licensed asset management companies or mutual fund distributors. And it's completely safe, and there is no instance of, stock market can go up and down, NAV can go up and down, but nobody can run away with your money. There are no such instances at all.
Yeah. So again, on digital, let me say that crypto and digital, guys, this is a totally unregulated industry. So nobody knows what's happening. Nobody knows what's behind the companies. And then when you're investing in that, and most of the people are investing in this because of the FOMO. When the anything goes up, every newspaper, every media wants to sell. They start talking about crypto is the future. And when it falls, they say that that people were not intelligent enough to understand not to invest. So guys, I like to say, please stick to what is regulated. At least that there is rigor and there is something behind that. So do not take that risk. It's not worth it. That would be, because the upside is obviously X or 2X, but the downside can be zero. So just be very, very careful. I would like to say on that. Ashish, also there's another very interesting concept which has come up called freedom sip. This is something that we used to anyway sell very, very regularly at Bajaj Capital. That but it's become a very popular concept now. So are you also offering a freedom sip type of a thing? Like, you guys, let me explain. This used to be like a sort of a package where there's no new product created, but what we say is, like, suppose you invest 20,000 rupees a month for 20 years. Okay, then you will be able to withdraw 1 lakh rupees a month for the rest of your life, or depending on how the markets perform. Or it can be for 30 years, 35 years, and we make a beautiful chart and show you the sensitivity analysis, 8%, 10%, 12%. So today this has been bundled and made into a product called Freedom SIP, where you invest 10,000 for example 10,000 for 10 years, and you get 30,000. It is said that you'll be able to get 30,000 for the rest of your life if the market gives you a 15% return. And this has become a, like the rage of the industry. So, and this is a simple combination of SIP and SWP. So Ashish, have you created some bundle like this? And what would you like to say about freedom SIPs, like which are becoming the rage of the industry today?
Yeah, so I think two things. One is that yes, even we offer such product. I mean, we just call it Goal SIP, but ultimately it's the same concept. And in fact, the guys who created it a few years back, those very two same guys are actually product heads for WhiteOak Capital. So we have very experienced team of people, and the guys who have been innovating the product for the last 10 years, which I would like to share with you. The second important thing is that the second important thing is that in India, we don't have enough by way of
Guys, it seems Ashish is facing some issue of internet at his side. So till Ashish comes back, let me take up a couple of questions. Priyanka Tamta is asking this question: is it better to make a lump sum investment or monthly SIP deduction? Priyanka, SIP is a must. What I believe, that for every individual, SIP has to be done. It has to be a part of your portfolio. This is like what you can say the foundation of the house. So SIP must be there. And whenever the market is dipping or you feel the market is attractively priced, then you can put in a lump sum that you have saved. So point is that it's not either or. It is, you have to do both, but SIP is the foundation which you should start now without any delay, and that whenever you have lump sums available, you should invest that lump sums. When the market is high, invest the lump sum, but take a systematic transfer plan. So the money goes into a debt fund, then systematically it will get transferred into equity over a period of time. So that's for the lump sum. But when the market is at a dip, it's very difficult to buy at that time. But that's the time to buy lump sum. If you can bring out the courage, that's the time you should put your money in a lump sum. So taking up the next question, Samaprit is saying that the number of players in mutual fund industry is shrunk, but how is that the industry is still growing? So this is a very interesting question. It's a very simple question to answer, but I will let Ashish answer that question.
very insightful. I'm sorry, before I got disconnected, other than the points on SIP, I was just saying that in our country, we don't have a government assured social security system, right? And we don't have too many retirement related, securities which are available to us. So I think everybody should do SIP, and I think that's the ideal. But coming to Mr. Samarpreet's question, very insightful question. I'll tell you something interesting. The number of players have shrunk. It is true, but there is a lot many new players which are actually coming in. And if you ask me my personal opinion, I think that in the next few years, like right now, we are just over 40 asset management companies and inching up. This year there are two who have launched. I'm sure next year there'll be a spate of more launches. So actually, the number of players has again started to go up. I think, and my sense is that next few years we might even double the number of players. Because I think number of players who come in, also they bring in diversity of product offerings, they bring in innovation, they bring in better penetration and geographic reach, right? So I think number of players is set to go up. But I'll tell you just one thing which most people miss out. While the number of players has shrunk, let me tell you an interesting thing. In the last 10 years, and you have also pointed out that the industry is still growing. By the way, not only growing, in the last 10 years, 10 years back, the total mutual fund industry was about 7 lakh crores. In 2000, when industry was 7 lakh crores and the total mutual fund industry was about 7 lakh crores, At that time, equity mutual funds was about 1.8 lakh crores and the balance was debt. Today, that 1.8 lakh crores has become nearly 20 lakh crores. And that 5 6 lakh crores of debt has become again 19 lakh to 20 lakh crore of debt. So what has happened is that within this, if you leave debt aside, if you leave the EPFO, ETF, all those things aside, just look at retail equity. You'll be surprised to know that the bigger players have lost market share in retail equity and newer players have actually gained market share. Now this is counterintuitive. If someone told you that industry has grown but number of players have shrunk, you might logically think yes, so big guys must have become big and small guys must have gone out. That's not the reality. If you look at equity mutual funds, if you look at retail, investors have become more meritocratic, more democratic, and actually the bigger players have lost market share. And in the retail equity space, the newer players have actually gained market share. So my sense is that if you read between the lines, the indicators are different. And second is that in the next few years, the number of players will actually grow multifold.
Yeah, Ashish, this is a very interesting point you have raked up. So there is now a huge thinking in the market, especially in the investor community, that a very big mutual fund has very less flexibility because they have too much money to deploy. So they'll have to go after very big stocks. So people have started preferring smaller, more leaner mutual funds with the smaller funds. So do you think that thinking is correct or that thinking is wrong?
No, sir. Actually, if you see the real data, I think that thinking is not wrong. I'll tell you the reason. I'm not saying it has to be like this always, but the point is here it is related to one of the questions we discussed few minutes back, where we were talking about equity portfolios which follow a very narrow strategy versus equity portfolios which follow a broad-based strategy. So one of the challenges related to this size point is that you are very very experienced. A lot of fund managers come and make presentations to you. So if I were to just ride on your experience, 10-15 years back, if a fund manager came and told you that I'm a value investor or a contra investor, and let us say his corpus was say 15,000 crores. Today he is managing 2 lakh crores, but he's still a value investor or a contra investor. So I think that fundamentally, how much alpha you can generate, there is a bearing of size on how much alpha you can generate. But if your strategy is broad based, scalable, and if it is not narrow, then that means that you will be able to maintain alpha with a higher size also. So it's like this, that yes, prima facie, the observation is correct that the bigger players have lost market share and the newer players have gained market share. But if you look at the data, then you will not have that.
Ashish, we seem to have lost him again. He's facing some internet challenges.
Yeah,
So,
I
Ashish,
was just saying that if the strategy scales with size, you will not have that problem.
yeah. And Ashish, your internet seems to be better now, finally.
No,
So,
my
we have a huge number of questions. So, we'll have to be very, very quick because we have 11 minutes left. So, so one of the question is that what should be the strategy to rebalance your mutual fund portfolio? So, I'll answer quickly and then I'll let you add for a small quick point. So, Sachin is asking this question, Sachin Kumar Rai. So, Sachin, what I would like to say, look, if you want to rebalance the portfolio, that means having a right allocation between debt and equity. Then one of the best ways to do this is go for a balanced advantage fund where the fund manager will do it for you because he's moving your money between debt and equity depending on the market conditions. When market is low, you'll have more equity. When the market is high, you'll have less equity, more debt. And that is how the rebalancing happens. Or you make a simple rule that 70% of my money is going to be in equity and 30% is going to be in the debt. And then on a monthly basis, you rebalance it, or you put it on a lot of these sites have an auto rebalance feature, but where it will put it in your card, but you'll have to approve those transactions. So that's how you need to go about it. Ashish, would you like to add anything here?
No, sir. I will just say that whatever you do has to be rule based. It should not be left to whims and fancies or subjective decisions. Once you make a rule, follow a rule, and I think all rebalancing should have some or the other rules behind it.
Yeah. So, and next question we are taking is Isha Sharma. She's asking a question that how do we avail advantage of systematic withdrawal plans in mutual funds? So, a lot of people have heard that SWP in a debt fund is very tax effective. So, if you can explain that a bit to them.
Yeah, so Isha, it's a standard feature, just like we've been discussing. See, how when you invest in a mutual fund, right? One is that you are putting money in a fund, but then how do you invest? Are you, let us say, you're putting 1 lakh rupees. So, are you going to put 1 lakh rupees, which is in your account? Are you going to put the whole 1 lakh into the equity fund, or you can put that 1 lakh into a liquid fund and then give an instruction to move 10,000 every month for the next 10 months? So, the point I'm trying to make is that how you will invest, how you will withdraw. For everything, there are certain facilities and certain features which are available. So the point is that a systematic withdrawal plan. It's there in the application form. It's a standard feature. Now, a few minutes back, Mr. Bajaj was talking about a freedom SIP or what I called a goal SIP. What does it say? It says that when you are a young person in India, there is no social security. There is no, nobody's going to give you a guaranteed pension. So you have to plan for your own retirement and your own pension. Let's say I am now 45 years old. For the next 20 years, I'm going to keep on invest by way of SIP. When I become 65, let us say I retire, I'm going to stop saving, but now I need to live off my savings which I accumulated for 20 years. So what will I do? For from 45 to 65, I will invest every month by way of SIP. When I become 65, I stop working and I want to live from my savings. I will do the reverse. When I was investing, I was doing SIP, and when I want to withdraw, I need monthly money for my expenses. So I will register something called a systematic withdrawal. So from my corpus every month, I can decide that okay, when I was saving, I was saying 10,000 every month. I saved 1,20,000 for 20 years. So 1,20,000 for 20 years, meaning I saved 24 lakh rupees. At a rate of 11% compounded, my 24 lakh rupees has become say a couple of crores. When 65, when I'm 65, I have 2 crore corpus. Now I want to withdraw 1.5 lakh rupees every month for my monthly expenses. So just the way systematic investment is a way of investing every month, systematic withdrawal can be a way of withdrawing every month. So these are standard features. They are available, and you must avail of them depending on your requirement.
Yeah. So I think very well said. So, quickly adding to that, Isha, see what happens when you do an SWP, suppose in a debt fund. Otherwise, it's got high taxation, but you need to be invested for 3 years. But when you do SWP for withdrawal, you're actually withdrawing your its capital first. So it becomes tax effective because by the time you reach your interest, it's already 3 years, and you're able to get that advantage of indexation and other stuff. So it becomes tax effective. You can meet a wealth manager, he can explain to you in detail. Tanya is asking this question that please delve into buy right and sit tight investing style. Do you does WhiteOak agree with that?
See, I think that a lot of times this is misunderstood. The point is that you have to do both the things, meaning that you hold on only if you have bought the right investment or the right stocks, correct? So it's a way of managing money. It is a way to ensure. See, because when you are investing, let's say you're buying or selling stocks, or let's say you are even buying a mutual fund. The point is that when you are buying or selling a mutual fund or stocks, ultimately it is something which has uncertain outcomes. It is something which is probabilistic in nature, right? So anything which has uncertain outcomes and anything which is probabilistic in nature, it means that if you take 10 decisions, there is a good chance that 5 times you will be right, 5 times you will be wrong. So whenever you're dealing in uncertain outcomes and whenever you are dealing with something which is highly probabilistic, it is better that you take fewer decisions but more concrete, high conviction decisions. So basically, if you ask me, it applies to everything in life. इट इज ए इट्स लाइक ए मूल मंत्र बोलते हैं जिसको हिंदी में फॉर इन्वेस्टिंग एंड फॉर लाइफ इट इज ए मूल मंत्र, right? So the point is that, but if you think that you have made a mistake, if you think you bought a wrong stock, if you have arrived, after a year, couple of years of watching how a mutual fund is managed, if you arrive at a conclusion that this is not working out, which means you probably haven't bought right, then you don't need to sit around on it. Sitting around on a mistake is not the right thing to do. Correct. So it is a well-known fact that if you buy a bunch of good companies and hold on to them, and if you're not someone who's going to compare performance versus benchmark, performance versus competitors, performance versus my neighbor. So if you are somebody who's not very, very worried about relative performance, if you're somebody who can buy a good fund or a good stock and hold on to it, then it's a great strategy. If you are someone who has the penchant for beating the index every year, if you want to beat your competition every year, if you want to do better than your neighbor every year, then you need a slightly more active style of investing. So I think the key is, what is your objective? What are you chasing after? Buy right, sit tight is always a great strategy to have. Question is, what is it that is your calling? What are you chasing after? Like I said, if you're going to compare returns every day, every month, then it may not work for you. So if you're very, very focused on relative returns, then you need a more active strategy. If you're somebody who can just sit on to something for the next 5, 10 years, then this is a great strategy for you. So it depends what you're looking for.
Superb, Ashish. Ashish, we have a lot of questions, so we have to be really, really fast on our answers and really brief. So Ashu Rajput is asking you two questions. One is, she's asking you what is your take on infrastructure and real estate funds, investment funds, rights, and also she's asking is that you have 20 years plus experience. What's the one major thing or quality that has made you successful as a person? So that's the second question she is asking you.
I think
So
second question. Ah, yes, sir.
yeah,
Sorry.
so you can take both.
Yeah, sir. So second question is easier to answer. Second question is easier to answer because, I think my biggest learning in my 23, 24 years is that you should be open-minded. If you're investing in the stock market, if you're investing in equity markets, if you're buying equity mutual funds, and if you're someone who's prone to forming conclusions or forming judgments, then I think it is not for you. The most motivating statement or the most insightful statement I ever heard was attributed to an American philosopher called F. Scott Fitzgerald. He said that the test of first-rate intelligence is is the ability to hold conflicting ideas in your mind, at the same time retaining your ability to function. So if you are, someone, when you're watching a match, एक ओवर हुआ, 2 ओवर हुआ, आपने तीसरे ओवर में डिसाइड कर लिया कि इंडिया हारने वाली है, then I don't think, that's not the right thing to do. So if you're somebody who's not open minded, who's not open to possibilities, I think then stock market is not the place for you. So I think that is one learning. The second one was on infrastructure and REITs. I think as far as infrastructure is concerned, I would just say that all growth doesn't result in profits for the shareholders. So I think, infrastructure projects, being that they are so long gestation, and is always public private partnership, lot of public or lot of government related intervention, approvals, long cycles, long gestation. So I think infrastructure doesn't necessarily make money for shareholders. I would generally not be into any such sectoral bets, more so not into infrastructure related sectoral bets. I think REITs are a different thing altogether. Real estate investment trusts are the optimal way for, if I am an individual investor, I have a couple of lakh rupees to invest. Obviously, I cannot buy a building and give it on lease to Infosys or TCS, right? But yes, if I'm an individual investor and if I want to invest in commercial real estate and earn from the lease rentals, then the best way to participate is real estate investment trusts.
Yeah, so guys, this real estate and infrastructure investment trusts are good investments. Infrastructure trusts, investment trusts, just be slightly careful because what is the underlying assets that you're investing against? REITs are still more broad based, but yes, you have to look at what is the underlying REIT. Every REIT may not be good, so you have to be slightly careful there. So next question is Yamini, that how does one capture the attention of FD investors and move them into mutual funds? Here I'll take it very quickly on your behalf also, because I'm sure you're talking about it every day. go for target maturity funds. And you explain to an FD investor that FD is actually a product which is not doing justice to an investor. Even if he's getting 6-7%, he's paying tax on it. The real return is only a 4% return, and that's less than the inflation. So over a period of time, the person is getting poorer. One of my investors, I used to tell him that. He said, "No, no, I'm a very conservative guy." Another day, after 15 years of following this strategy of keeping money in debt, in FDs, 70% of the asset, he told me, he said, "Look, I now realize that I could have had so much more money, but I chose to be over conservative." So, just don't be over conservative. Do the product that is required as per that. Okay, so next question is by Yatin Narang. He's asking between open-ended and close-ended mutual funds, which ones are better for a young guy, 25 to 35? So, Ashish, what's your answer there?
No, I think that, I think you should go for open-ended funds. I think you should go for open-ended funds. And there are not many close-ended funds being issued right now. But in
I
any
think when
case,
he's talking about close-ended, he's talking about ELSS. Okay, so
yeah, but
I
I
think,
think, yeah, please.
yeah, if you have a capability to save tax under ELSS, 1,50,000, then go for ELSS first because you're saving tax there. And after that, it's always better to have an open-ended fund. I will let you finish on this, Ashish.
No, no, I was just saying that, it's just better to have the flexibility of open-ended funds. That's the simple thing, yeah.
And then we have Naina Bhardwaj. She's asking this question, that what's the right combination for factors for a balanced portfolio for consistent performance? I think Naina, Ashish has already told you that the broader your portfolio is, the more consistent performance you'll have. So if you want a consistent performance, go for a broad-ended mutual fund which has huge number of stocks in it. It'll give you a more consistent performance. If you go for a more concentrated fund, it'll give you more ups and downs, but it may give you an alpha over the others. Ashish, please add to that.
Yeah, I think it's like this, that the if you have if you have a highly concentrated portfolio, then you will leave certain factors exposed. Meaning that if you say that I'm only small cap, I'm only growth, I'm only value, the point is that the benchmark is not only small cap or only growth or only value. All of these are factors which contribute to performance. So when you have a balance of all factors, then you will be able to overcome all kinds of macro conditions, and your performance will not swing from wild outperformance to wild underperformance and back and forth. So I think that's the absolutely key point, that having a broad portfolio, ensuring there are all sectors in it, there are all market caps on it in it, but of course without diluting the quality of stock picking. See, most of the people don't have 30 equity analysts. Why do we have 30 analysts? Because we want to do high conviction investing, but we want a broad portfolio. I think that is the key thing.
Yeah, and this also answers our next question, which I was going to take up by Deepak Gupta, who's asking us versus active versus passive, that which is a better investment strategy for a long-term return. So, Deepak, it also depends on which passive you're choosing for. Okay, so if you're choosing a Nifty, but then please understand Nifty is a sort of a post-mortem. These are the 50 best companies that have performed. It doesn't mean that you'll catch the companies which are going to get added to the Nifty, which may have given the best returns. So for me, in India, it depends on the market to market. When the market is very mature, maybe passives are a good investment. But in a market like India, where there are good stocks, bad stocks, and there is a role for an investment manager, then as per me, actives are better. Ashish, do you agree with my view, or do you have a separate view?
No, no, no. I completely agree. I think active funds have a lot of potential. In India, I'll just tell you a very simple thing, in more simplified way, that in US, which type of companies are blowing the lights out? Which kind of companies are beating the benchmarks? Which kind of companies are the so-called hot companies? They are all Mr. Musk's companies. But in India, we are in a market where even footwear companies still getting listed, right? So India is a country with $2,400 per capita income. China is $12,000 per capita income. That's an example. US is 60, $70,000 per capita income. right? So the stage of evolution where we are, in one sentence I can tell you, do not worry about index capturing the market before the market has captured the economy. I think that is something that you should keep in mind. Bulk of the bulk of India's corporate sector is not even listed. It is not even reflected in the capital market. So it's too early. There is a lot of potential to generate alpha. And I don't think we should draw any inferences based on, say, 1 year, 2 year, or based on some American examples.
Yeah, and one last question we are going to take up today is that, which is a quite an interesting question, is that there are still a lot of mutual funds which are investing in high US stocks. So
Hmm.
they are asking that, Shreya is asking this question, do I pick up a mutual fund which is only India focused, or do I pick up a mutual fund which has some exposure to US, this thing? And there are a couple of people who have asked this question, that
Yeah.
what is the safety, and which of these funds are likely to do better.
See, I would go to the other extreme of saying that anybody who is investing in equity must have some exposure to US, because US is the mecca of all technology, all innovation, and there are very many companies. Even if you want to participate in Indian growth, or even if you want to participate in emerging markets, still those companies are listed in the US, right, and in the advanced or in the developed world. So I don't think that US investing in US is not just a theme or a fad or something. If I have my money invested in equity, then I think based on whatever advice I get from, say advisors at Bajaj Capital or anybody at Bajaj who's a financial expert, I think that if I'm investing in equity, I think investing in US is a must, because US is the world's, it's 30% of the world's economy. It is 30 to 40% of the world's market cap, and it is the center of all new technology and all new innovation. May it be digital, may it be space, may it be biotech, may it be cutting edge research on life sciences, medicine. So I would actually go to the extreme saying that everybody should invest in US, some extent. I'm not saying put all your money in US equity, but if you have an equity portfolio, then definitely by all means consult someone and figure out how you can participate. I think people should invest in US. I would not say the same thing about Brazil or Russia or China, but US market is as good as the global market.
Yeah, so I would definitely agree with Ashish here, guys, that you must, when they say buy when the stocks are lowly priced, US tech stocks were very high priced, and today they are available at a much better value. So if I look at my own portfolio, my least performing assets are US and China. But at the end of the day, I'm continuing to invest there. I'm personally investing more and more there. And because I believe that whatever goes down has to go up, and probably this is a great time to come when the confidence is low there. So yes, please do pick up a fund. Bajaj Capital would be happy to help you find these funds. And there are many ways to do it, to build up a portfolio across. But yes, the returns may not have been good in the last 2 3 years, but that's the time to invest. So thank you, Ashish, for being with us today, and it was amazing having you. And sorry, everyone, we did have some technical glitches, but I hope we were able to add value to your life and start you on your wealth creation journey. And everybody who asked a question, will answer it offline and make sure you get your answers to your question. So, Ashish, some last words for all the viewers today.
No, I think next few years are going to be a great set of opportunities. I think it's most important to not only start investing, but to continue to invest. We all contribute to India's growth, but how do we directly benefit from India's growth? I think the stock market is the best way to participate. So thank you very much for having me here. It's absolutely an honor to speak to the audience.
Yeah, thank you. Thank you guys for joining us today. It was great pleasure having you. Thank you.